over to you, sir, to address on the topic of cost of capital using Excel.
Nikhil sir, your time.
Thank you, Vaishnav. Thanks a lot. Thanks a lot for that fantastic introduction. Hello, everyone. Good to see you. When I say good to see you, I can't see you, but then still good to see you. I
Vaishnav,
would
you
really
can
love
sit
to
on.
know. Yeah. So you're saying something?
No. You can start.
Sure. I would really love to know whom I have here. So if you can't interact maybe on uh, phone, or if you can't interact directly through your voice, if you can interact through chat, I would really love to know your name, what is that you are doing currently, or what is your specific role into the college, and your years of experience. If you could type that much name, your specific role, and your years of experience in the chat, please. I would really love that from you.
Yes.
Waiting for your
Yes. Participants, you can use the chat and mention your name, your experience, so that you can know.
If you would like to unmute yourself, you can do that as well. Yeah. If you would like to unmute yourself, speak. I'd really love to hear from you before we go on. I can't
Participants, you can unmute and introduce yourself. Or you can use chat.
Yes. I think people are still joining in. I'm seeing some
Yes,
more
I
people
think
joining in.
it is a hard time. Now only they may enter into their home. Or some of them are traveling to home.
Okay. So they had their day in the college and now they are going back home, is it?
Yes.
Oh, wow. Busy people.
Yes, I think Manikandan professor, he mentioned having 10 years.
Busy people. I'm still waiting for some responses. I have no responses. Can you see any responses, sir?
One response only from chat.
Okay. I still can't see any response as such. Maybe I'm not able to see that. All right.
Okay.
All right. So I think today the topic that we are going to discuss is cost of capital. I would really love to know from you, when we are talking about capital, what are the different components through which a company can raise capital? If you could tell me that, different components, different sources through which a company raises capital. Anyone?
Yes, sir. Somebody mentioned.
Sir, I am not able to see the responses. Could you check?
Participants, you can mention to these. Yes, sir. You need not send me message. You can send to Nikhil sir directly. I think Vishwa Nayak.
To everyone.
You can post us to everyone. They mentioned equity and debt.
Participants and debt.
Yes. Participants, you can share to everyone, or you can share to Nikhil sir directly.
Yeah. Maybe that's some issue, technical issue. Yeah, I see some responses. Equity, debentures, retained earnings is internal source. So retained earnings is not something that we are talking about. We are talking about sources where the company is starting and they are getting funds from outside. So it's first equity, second debentures, third would be, and again, shareholding through preference shares. So that's one. And fourth would be any other loans. Now, when we are talking about debentures is something that is a bond, but we'll be getting some loans also from companies. Now, when we are talking about cost of capital, we are talking about how much is the company bearing as cost in order to generate the capital from all these sources. So, which is equity, which is debt, which is preference shares, and which might also be any loans. Overall, for all these sources through which you are getting the money, how much is the cost that you are bearing? That's what we are going to talk about today. I see one response now, Vibha. Yes, Vibha is from Goa. Oh, wow. Fantastic. We have people from Goa as well. Nice. All right, I'm going to share my screen. I think I have the rights to share my screen.
Yes, yes, we are given.
And we are going to directly, without wasting any more time, we'll just directly dive into the topic. Now, the way that this is going to flow is first we'll discuss the basics in terms of concept, and then we'll move to the Excel calculation. Also, we are going to do an actual live calculation using the live data for any one company that you like, the cost of capital. We are going to calculate the cost of capital live on Excel for any one company of your choice. Okay. The only condition here is that that company should have equity and should have debt, and it is a listed company so that we can get the data, right? That's the thing that is the agenda for today. So let's first start with the basics of concept of cost of capital. I'm sharing my screen now. Just confirm if you can see this.
Yes, sir. We are
Yeah.
able to see.
Great. Fantastic. Now, as I have been told, these all people are faculties. So you have put me in a fix to talk to people who already know about finance. So I am in that dilemma where I should begin. So, but first, let me tell you who I am. Vaishnav has introduced me very well. I am a CA. I've passed all my exams, all three levels in first attempt. I have 10 years of experience. I've been doing trainings for a lot of time. I also specialize in communication skills, and I would like to call myself your happiness partner. Today, I want to be partner in your happiness so that you can understand the cost of capital along with Excel calculations, along with practical implementations, and tomorrow you can make your students happy. I want to be partner in your happiness in that way today. Okay. There are three things that I'm expecting in next 1 hour. Number one, I'm talking to you, which means I'm not talking to a batch of 24 participants. Make it about please you and me. I would really love to listen to you either virtually or through your audio, through your chats. Try to make it interactive. Second, you already know certain things. Your glass is already maybe half full. I would really love to first empty your glass, speak it out. What is it that you know so that we can talk about some things that you do not know. See, if I know your level of understanding, I can maybe take it from there. Otherwise, I'll be going as I understand or as I perceive your understanding. So I would really love for you to empty your glasses first. And third, you can interact with me in either of these three languages, English, Hindi, Marathi. I know only these three languages. Please, Tulu, Malayalam, Bengali, Punjabi, ye mujhe nahi aata. So let's try to restrict ourselves with these three languages. With that being said, let's get into the concept of cost of capital. Okay. Cost of capital refers to minimum rate of return that any company must earn to satisfy its investors, which can be either equity investors or debt investors, and to also justify whether the investment is satisfactory or not satisfactory. If you are not even recovering your cost of capital, then that investment may not be the right choice. So we are essentially calculating the cost of financing the operations of the business through either debt or equity. Now, this concept is also used by leaders to get how much is a particular new project going to earn, going to give us in terms of profit, so that we can analyze whether or not to take a decision to invest in that new project. You must have heard about the concept of NPV. For NPV and IRR calculations, cost of capital is the rate that we use for discounting. So this is an essential concept which needs to be calculated even for that NPV and IRR calculation. So this is the base. This is the base. Now, some important things. I'm just going to rush through this because I understand some of you already have the understanding, but it's important that we are at some base level before we go into the calculations. So the cost of capital useful in investment decisions like capital budgeting to evaluate a project. It's important to assess any new return on investment or to benchmark a performance of a particular project. This is the amount till which I should earn income, and it should never be below the cost of capital. So any new project, any new investment should at least earn the return equal to the cost of capital. Only then it would be useful. Next, sometimes, see, cost of capital can help you to understand whether you should make any changes in your mix of capital. In general, cost of equity would be higher and cost of debt would be lower. Can someone tell me why is that? Why would cost of debt be lower and why would cost of equity be higher? If anyone can tell me. Yeah. Do you agree with me? If you don't, you're free to share that you don't agree with me. But
Yes, somebody answered. So it is cheaper source of fund. Participants, you can directly mention to everyone. I think you are sending to me.
Okay. See, it's cheaper is not necessarily what I'm looking for. The reason why debt would be more effective in terms of cost is there is something called as tax shield. See, on interest, you can actually get tax deduction. We are going to get into the calculation very soon on Excel, and you'll see that when we calculate cost of debt, the cost of debt is calculated with a tax shield, wherein you are actually getting the deduction for the interest amount, which is not available in case of equity or preference shares. So for preference shares or for equity shares, there is no tax shield that is available. For debt, there is a tax shield that is available. Because of it, by default, the effective rate of cost of debt comes less than the cost of equity. So it is always better that you have cost of debt if you want to reduce the total cost of capital. But the other side of this would be jitna jada debt, more the debt, more the chances of you not being able to repay the debt. So that is the other side of angle. But in terms of capital structuring, that's an important point, right? Also, to determine whether or not to pay dividend, you can use cost of capital to assess whether you are having more risks. Like just I said, that if there is more cost of debt, the risk is high. More debt, more risk. Less debt, less risk. So risk assessment is something that can also be done with the help of cost of capital. Now, we have just discussed there are two types of major inclusions in cost of capital. One is cost of debt, which is the cost of all the borrowed funds. This debt can be either in terms of bonds, loans, or any other types of borrowings. And this is what I just mentioned, that cost of equity is usually more and cost of debt is because debt holders are less risky. They are paid before equity holders. So again, for debt holders, there's a safety that whenever the company goes bankrupt, I'm going to be paid. For equity shareholders or preference shareholders, there's no safety. So that is why it is, in terms of risk, it's less risky. Okay, this is the formula. We calculate cost of debt as pre-tax cost of debt into 1 minus tax rate. Now, pre-tax cost of debt is nothing but the rate of interest. Whatever is the rate of interest into 1 minus tax rate. And cost of equity is the return that the investors or shareholders are expecting from the investments. Usually, the cost of equity is typically higher and it is calculated using the CAPM model. CAPM is capital asset pricing model. That is what we will be using for calculating the cost of equity. Now, what is CAPMS? For this, we are going to need certain assumptions or certain research from the market. It is used to price any investment or to price the company based on expected rate of return. Now, investors use this model to determine whether should they invest or should they not invest. And the formula is very simple. Risk-free rate of return plus beta into RM minus RF is expected market return minus risk-free rate of return. Now here, if you see, there are three factors that we are talking about that we need to have even before we move to Excel. First, we need to have risk-free rate of return. Now my question is, from where do we get risk-free rate of return? What is the risk-free rate of return and from where can I get that? Because unless I have that, I can't go into Excel and do any calculations. I need to have that first. So from where can I get risk-free rate of return? Tell me. Yes. You can unmute and speak as well, or you can chat. From where can I get risk-free rate of
One person mentioned rate of treasury bills.
rate of treasury bills? In Indian context, we consider risk-free rate of return as the rate of return on a 10-year government security, 10-year-old government bond. And right now, the rate of return on a 10-year-old government bond is in the range of 6 to 7%. In a while, we are going to do the calculation. I'm going to show you directly on Google how we can find it. If you directly go and search, you can find the risk-free rate of return. Right now, to be very exact, it is 6.98%, which is the exact rate of 10-year government bond. Okay, that's what we'll consider as risk-free rate of return. Next is beta. Now, beta is the measure of risk. It is depending on the volatility of the market. This is again something that would be readily available if you go and search for some websites which provide market data. And the best websites that you can use is Money Control and Screener, especially for the companies which are listed companies. If the company is not listed, then we might have to calculate beta ourselves. Now, this calculation itself is a different 1, 2, 3 hour session altogether. But for our calculations, we are going to consider a market beta which is readily available for one particular stock. Okay, so this is the measure of risk. And third is expected market return. Now, this is the return that that particular company or that particular industry is expected to grow over next 4, 5, 10 years. This is the expected market returns. Unless we have these three things, we can't calculate cost of capital, especially the cost of equity. I'm stressing over this because this is what we are going to need even for next calculations in Excel. Next. So this is what I've mentioned, that 10-year government of India bond rate, currently around 6 to 7% is the risk-free rate. And beta is the measure of assets volatility. We also call this systematic risk. Systematic risk is the risk of if the market moves up and down. Now, if you have seen yesterday, the market dropped by around 1,000 points. Now, if the market drops 1,000 points, how is your company going to respond to it? Is the beta. Is it also going to drop? If yes, is it going to drop at the same percentage as the market? More or less? So beta would be giving you the volatility and it would be measured in these lines. Okay, if the moves in the line of market, it would be 1. Exactly market copy kar raha hai, so it would be 1. If it is more volatile, more than 1. Less volatile, less than 1. If there is no change, market moves anywhere, there is no change, then 0. And if the market goes up, but your company's stock goes down, it's a negative correlation. Okay, so this is something that we would get, we would require for the cost of equity calculation. So we are not talking about this kind of models here. CAPM model has nothing to do with this. right? This is a different model and we are calculating a different model. All right. And the final thing that we are going to talk about before we move to Excel is weighted average cost of capital. WACC is the total weighted average cost of debt and equity. And this is the overall cost of the company. So whenever we say cost of capital, we are actually referring to weighted average cost of capital. Because cost of capital can't be measured only for equity or only for debt. We would measure this to actually calculate WACC. So the final calculation of cost of capital is nothing but WACC, weighted average cost of capital. And it involves ideally two things, but it can be more than two in case there is a preference share capital there. That would be the third thing. So debt, equity, and preference shares is what it would be included in the weighted average cost of capital. Okay, the calculation combines both cost of debt and cost of equity, where we'll weight how much is the total amount or how much is the total proportion of debt from the overall capital. Now, WACC, as I have already told you, is used to determine the NPV of the project. So this is an important discounting rate, which is used for all the other financial calculations. And the formula is like this. WACC is calculated as equity divided by the total market value of equity divided by the total market value of debt plus equity into the cost of equity plus market value of debt divided by the total market value into cost of debt multiplied by 1 minus t. Why? Because as I mentioned, there is a tax shield. Tax shield calculation is there. So whenever we calculate cost of debt, we will be calculating the cost of debt after tax because there is a tax shield. Okay. If at all there is a preference share capital, we'll also consider the preference share capital in this calculation. All right. So that's how the calculation will go. All right. I think that is it. WACC is one of the most important factors, internal and external. Usually it is per unit of capital. How much is the cost? How much is the rate of interest? Whether that capital is being raised either from equity or from debt or from preference shares. For 1 rupee of capital, how much is the percentage of cost we are bearing is WACC. Okay, so this would be our final cost of capital. And you can change the structure to change the WACC. Debt portion, if you increase the debt portion, the WACC will go down. The reason for that, again, I already mentioned that cost of debt is actually lower than the cost of equity or preference shares. So since the cost of debt is lower, increasing the debt portion will lower the overall cost. All right. So, all right. I think this is enough. If you have any questions about the concept, we can take any questions. Otherwise, now we'll just directly move to the Excel calculations. I'll just share my Excel screen. And first I'll stop the share here. Yeah. Can you see this?
Yes, sir.
Yeah. Perfect. So this is a very, very basic first cost of capital calculation, where there are three sources. The first source is equity share capital. Second source is preference share capital, 7% preference shares. And third source is debentures. Now the tax rate is 30%. That's the general tax rate in India for corporates. Now here, cost of equity is something which we have not yet calculated. So this is directly, we have considered the cost of equity as 9%, which is provided. Okay, this is the basic calculation. So we are directly going with an provided figure of 9% of cost of equity. It might be calculated using the CAPM model. The cost of preference shares is already provided 7%. Since the preference share capital is getting the dividend of 7% and there is no tax shield. Usually we pay dividend out of tax paid income, not before tax income, right? So since we are paying dividend from tax paid income, there's no tax shield as such. So the tax shield is applicable in case of debt. If you see this formula, I want you to look at this formula. The cost of debt is calculated as 9%. Now, from where have I taken this 9%? 9% is the rate of interest on debentures, which is mentioned just here. If you see debentures, 9%. This is what we have. So this 9% is the basic amount, basic interest rate multiplied by 1 minus tax rate. If you remember, the after tax cost of debt is calculated as before tax cost of debt into 1 minus tax rate. Now here the tax rate is 30%. So I calculated this 9% into 1 minus 30%. And that gave me 6.3%, which means that I'm effectively saving 2.7% is equal, which means 9 minus 6.3. 2.7% is what I'm saving because of tax. Okay, so after tax cost of debt is 6.3. Now, how do you calculate weighted average cost of capital? Cost of capital is linked to the cost of equity. Cost of equity is directly linked. The linking is very simple, equal to, I'm just going to link it here. Same thing I'm going to do here also. Preference, I have linked from here, is equal to preference share capital. And debt, I am linking from here. Now, same way, I have already done this calculation. Let me do it again for you. Equity, total amount of equity share capital is 30 lakhs. Total amount of preference share capital is 5 lakhs. If I just copy this formula below, it would be updated. I don't need to link it again and again. This is linked. This is linked. And I have the total debt, total capital of 50 lakh rupees. Now for calculation of weight, this is where you might need to use one formula of equity weight, total amount of equity divided by total amount of capital, and freeze this amount. D26 is the cell that you can freeze by typing F4. Now, for those who are new to this freezing, once you do F4, this particular cell would be frozen. Now, if I copy this formula below, copy and paste, and you can check. This D26 has remained constant. I want D26 to remain constant because the denominator is still going to be 50 lakh for all these three. So I've just done that by freezing it. And now you can see the weights as 6.6, 0.1, and 0.3. So the effective weighted cost of capital is basic cost of capital multiplied by the weight. If you can just copy this formula to all three places, and you can see the total of this, actually this would come to like this. If you do the total, it would first look like this. But then since we want this amount to be in percentage, you just click here, click on percentage, and this amount is converted into percentage. So 7.99 is the effective weighted average cost of capital in this case. This is what we have calculated. The weighted average cost of capital without basically calculating the cost of equity. We have cost of equity here. That is something that is readily available for us. Okay, this is the very, very basic calculation. Now, we will go into a different calculation. This is the second calculation. Here what we have is, we have dividend already provided to us. Now, equity share capital is there, 25 lakhs. Face value of share is 10 lakhs, 10 rupees. Securities premium, reserves and surplus, shareholders fund, debentures, 10% debentures. We also have dividend paid, dividend growth rate, current market price of shares. This all information is something which is readily available. And we are calculating the cost of equity and cost of debt using the dividend method. Now, here, the formula for cost of equity using the dividend method is dividend into 1 plus growth rate. Now, growth rate of dividend, if this can be applicable only for those companies which are paying continuous dividend year on year, and that dividend is consistent. If there is no dividend, this method can't be used. We need to use the basic method, which is the CAPM. Okay. I just wanted to mention this because this is also something that can be used. Now, dividend that the company is paying recently, the dividend that is being paid is 5 rupees. The rate of dividend growing every year is 10%. And the market price of share currently, today, is 60 rupees. This is what have been provided. The cost of equity would be calculated like this. Cost of equity dividend per share multiplied by 1 plus growth rate of dividend. Now here the growth rate of dividend is 0.1. So we have considered that as 0.1 here, divided by the market price of share. The market price of share today is 60 rupees plus the total growth rate. So whatever is the growth rate of dividend plus the first calculation, you get the cost of equity as 19.17%. And the cost of debt, again, similar to that what we've calculated before. Here is the formula. Interest into 1 minus tax rate divided by net proceeds. Now, net proceeds is how much are we going to pay back. So cost of debt is 10% into 1 minus tax rate divided by the net proceeds. The net proceeds is total market price that we are going to pay for this if we buy them today. This gives you cost of debt as 8.75. And the weighted cost of equity calculation is still the same as we calculated before. First, we need to take the cost of capital, 19.17%. Second, cost of debt, 8.75%. Now, here I have taken the market price and not the face value. This is something which is important. Whenever we calculate the weighted average cost of capital, we consider the market value of debt and market value of equity. Now the question comes, from where do you get that? The market value of equity is directly available for equities or equity shares which are listed in terms of their market price. So for the listed companies, the market value would be current market price multiplied by the number of equity shares, which is nothing but market cap. The number of outstanding shares multiplied by the current price will give you market cap. In this case, this is the market price. See, equity shares, we had 25 lakh share capital, face value 10 rupee each. So which comes to 25,000 equity shares. Sorry, 2,50,000 equity shares. And the market price is 60. So the market value of equity is 1.5 crore. And face value of debt, we have been provided that is 12 lakhs. And it has already been mentioned that the current market price of debentures is only 80%. Now, for real life calculations of market value of debt, we actually don't have any market value for debt unless the debt is freely listed in the market. Okay. So for market value of debt, we consider nothing but book value. Book value is whatever the value which is mentioned in the latest financial statements is what we will consider after tax. So here, since the market value is specifically provided, we will consider that. This is only available if your debentures are listed. If the debentures are not listed, or if you have only taken loan from bank, there is no market value for loan from bank. Whatever is the outstanding amount as per the financial statements, that is the value for the loan. So you just consider that. Okay. We have considered both market value of equity and market value of debt. And again, the same calculation. Weight is calculated as cost of equity or the total amount of equity divided by the total value of capital. And here, capital or the amount of debt divided by again total amount of capital, which includes debt and equity. And the percentage is calculated. Cost of capital multiplied by the proportionate rates. That's how simple it is. There's no complication as such. The only complication is from where do you get these figures. For the actual calculation on Excel, you just need these 5 columns. That's it. Source of capital, cost of capital, the total amount of capital. Weight is what you'll calculate on the basis of the amount of capital. And the proportionate percentage is also what you'll calculate. These 2 figures is what you'll calculate on the basis of the earlier 2 figures. So all that you need is this much. These figures is something that you need to calculate. And we are going to see live how we can calculate. You tell me any one company that you want me to consider for doing this calculation, and we'll do the calculation for that company. Any one company which has their shares listed, we'll take that as our example and we'll do it live right now. Which company do you want me to try? You can unmute and tell me, or you can just mention in chat any one company. Yes. Anyone? ITC, I see Reliance, I see ITC. I already have for Reliance. I had calculation for another client of mine for Reliance. I already have that ready in front of me. So I think we can do both. Why not do both? Chalo. First, what we'll do it for ITC. Let's see. We'll try for ITC. I'm going to do this for ITC for FY 2024. Okay. I'm just going to share another screen. Can you see my screen, other screen also? Can you see my Google screen right now? Yes or no? Can you see my Excel screen? No. Acha, no. I see that you are saying no. So you can only see the Excel screen. I need to shop this share, and I need to show this again. Okay, let me do that. I am going to share my screen once again. Here. Let's go on screener. Can you see this now?
Yes, sir.
Yes. On screener, and we are going to search for ITC Limited. This is the data that is available. Now, first, we'll just have a look at all the data here, and then I'll stop the share, and then we'll go to Excel because I may not be simultaneously able to move between 2 screens, right? Is there any way where I can split screen? Any way where I can split screen? Sir, can you help me with this? I have not tried that before.
You want to show 2 screen at a time?
2 screens. Yeah, I want to show my Excel screen as well as my Google screen.
What you can do is you can go for share full screen.
Okay.
And you can that box
Then I can just tab.
Right and left side, split screen.
Okay. So you can see the screen, right? You can see the screen.
Yes,
right?
now we are seeing the
Now,
screen.
Can you also see my Excel screen?
Yes, but now
Okay,
that is it. Now you can
Perfect.
go for split. We can see both.
Perfect. Perfect. This is what I wanted. Great. So now we are going to do all this calculation from beginning. I don't have any figures right now in front of me. We will do everything with start. Okay, 0, 0, 0, 0. Let's just start with first calculation of cost of debt. This is what we'll calculate first. Then we'll calculate the cost of equity. So first is cost of debt for financial year 2024 for ITC Limited. This is what we are doing. Let's go to screener and let's see the first thing that we need is interest. Tell me, where can I find interest in the P&L? We can go to P&L. This is the consolidated figures. And if you see here, we can see March 2024 interest figures. These are the interest figures. For March 2024, the amount is 80, and these amounts are all in crores. So 80 crores is the interest that ITC has paid. So I'll just go back to Excel and I'll type here 80. This is the interest expense. Now the total debt. Where can I get the total debt? I need to go to balance sheet. I need to check their liability side for borrowings. This is the borrowings amount. If you could see this, this is the borrowings amount, right? So March 2024, the borrowings is 303 crores. 303 crores. I'll go back to Excel. And in the total debt section, first I typed interest. Now I'm typing total debt. So the cost of debt. Now, since, see, when you go directly to screener, you can't see any rate of interest anywhere. When you download, let's forget about screener also. If you download any financial statements for any company, there is no rate of interest that is mentioned in the P&L or balance sheet. You directly have the amount of interest and you directly have the amount of liability or the amount of debt. So now these are the two figures that you are going to have. So you need to calculate the rate of interest by doing this calculation. Interest divided by total debt. That's it. So this company, on an average, is paying 26.4% on their total debt, total borrowing. Now, this might be consolidated figure where one loan can be 30%, another loan might be 20%, and the average is 26%. Okay, we don't have that individual information right now. But on an average, this company is paying 26.4%. Okay. Now, this is before tax. We have not yet considered the tax shield in this calculation. So now what we'll do is we'll consider the tax shield calculation. First, we will check how much tax ITC has paid for financial year 2024. Now, I need to again go back to P&L and check amount of tax. Now, here, if you see, there is no amount of tax, but there is a tax percentage that is provided. We have the profit before tax, 27,140, and then we have the tax percentage directly. Now then, maybe I can directly go and use the tax percentage because anyways I need the tax rate. Or if I want, I can do the calculation myself. The income tax expense can be calculated as profit before tax, 27,140 into 24%. Because the tax rate is 24%. So the tax is 6,514 and the profit before tax is 27,140. So the effective tax rate is, it would again come to 24%, right? You can directly take the tax rate if it is available, or you can calculate. In the financial statements, if you actually go and see ITC's financial statements, the tax rate might not be given directly. So you'll have to use these two figures and then come to the tax rate. Okay. Assuming that you have calculated the tax rate, the cost of debt after tax will be calculated as cost of debt before tax, which is 26.4 multiplied by into bracket 1 minus the tax rate. The tax rate is 24%. Bracket complete. This will give you cost of debt after tax, which is 20%. This is our cost of debt. That's it. Now we need to calculate the cost of equity. Just now I mentioned sometime before that the risk-free rate is nothing but 10 years bond rate for government securities. So if you can just search here 10 years government bond yield in India. And see, now these are various things that are coming up. And if you see, highest is 6.78. Just some time before I calculated this, and this is 6.58, 10 years bond rate. You might need to go and check the official website. I'm just, for the sake of paucity of time, I'm taking something that is readily available. 6.58 is what I'm getting. I'm going to consider that for now. 6.58, 6.5823 to be more exact. This is the risk-free rate of return. Now, beta, we don't have to calculate the beta. That would also be available directly here, either or screener or on money control. Now, what I know from my experience is screener doesn't give you beta directly, but that can be available on money control. If you go on money control and search for ITC, here is the detail and here is the beta. 0.71 is the beta of ITC. We can directly consider this 0.71. And the market return is again based on your historical analysis, or since ITC, now ITC is in which sector? What sector is ITC? Yes. You can directly go and search for that sector's market research. So what do you think? What should I search for? Which sector? Consumer durables? What should I consider? Yes, tell me. For ITC. Can you find this directly? You can't find this. Now tell me, what is the sector that I should search? What is the major sector in which ITC performs?
And
Anyone?
one person is mentioning FMCG.
FMCG. If you go for FMCG, this is something that would be available. See, they are saying that for FMCG, 5-year return 140, 1-year return, 3-year return, 5-year return. This is what is the performance. So you can consider one rate, 3-year rate of return 37.34%. This is the expected rate of return for the future. What is it that you expect this thing to grow? For the simplicity, let's take 12%. Is what I'm expecting this to grow for next 5 years. Okay, this is based on your research or on the basis of market analysis of that particular sector, of that particular industry. So this is expected market return, and the cost of equity would be calculated as is equal to risk-free rate plus the market shield is calculated as market return minus risk-free rate of return multiplied by beta, multiplied by 0.7. I have considered the risk-free rate plus market return minus risk-free return into beta. And that gives me cost of equity, 10.43%. I have cost of debt, I have cost of equity. All that I need to do is just link it. Equity is 10.43, debt is 20.07. Now, here, the amount is market value. This is market value. Now we will get the market value directly from either money control or screener. You go anywhere, you can find the market value. The market value is nothing but market cap. This is the market cap, 511,890. I'll just confirm this amount also on screener. Yes, 511,890. This amount is also in crores. So this is the total market capitalization for ITC as of 2nd April 2025 when we are calculating this. So we can just consider this as our 890, 511,890. I'll just confirm. Yes, 511,890. This is the market value. For debt, there. So we will consider the book value, and which was 303. 303 crores was the total debt. Now, if anything that remains is, the thing that remains is just calculate the weight. The weight is calculated this divided by the total, freeze this and this. If you see, the majority is equity. They have very less debt. So you would get the cost of equity very close, the total cost very close to cost of equity, because the weight of debt is very less, though the difference is too high. See, the cost of debt is 20%, the cost of equity is 10%. It's almost double. But since the weight of equity is almost 99.9%, it would not make any difference. Now, if you calculate this, it should be close to 10%. Very close to 10% should be the WACC. That's what it is. 10.43%. So cost of equity is same as cost of weighted average cost of capital, because ITC has almost zero debt as compared to their equity. And that is why, if you remember, I mentioned that whatever company that you take a company which has a good balance of debt and equity. If you don't have good balance of debt and equity, then the WACC would not be very relevant. Now, on the same lines, I have already done the calculation for Reliance. Someone was mentioning that you should do it for Reliance. I already have the calculation for Reliance. I'll just show you that. The interest expense for Reliance is 23,118. I'll just show you this too. This is something, again, I have taken from here only. From screener. I have taken this figure. Interest amount is here for March 2024, 23,118. So I've considered this amount. The total debt also I've considered from the balance sheet. The income tax expense is considered from this 25%. And the income before tax is something that I've this amount, I think I've taken from, this is different. This is the amount that I've taken from money control. Let me just confirm whether my amounts are correct. Balance sheet, borrowings, 458,991. That's correct. That's it. The cost of debt is 4.4%. The cost of equity, this is again something which is taken from whatever that I showed you just now from money control websites. And since now they have a good match of equity and debt, you can see the weighted average capital is coming in between these two. The cost of equity is 12.46, the cost of debt is 4.4, and whereas their weighted average cost of capital is 10.79, which is a good mixture of both, right? So I think this is it. Now this tells you, now whatever is the total WACC would be relevant for your NPV and IRR calculations. I also had some NPV and IRR calculations here. Whatever project that you are taking, if your NPV is coming positive, only then you will be going to invest in that. And that discount rate would be this WACC calculation. Whatever that you calculated as WACC would be the rate of discount that you'll use for NPV and IRR, right? So this would be the base for some future calculations, whether or not to invest in a particular new project or not. At least the project should give you the returns of 10.79% in case of Reliance and 10.43% in case of ITC. If that project is not giving you that much money, it's not worth to invest in that particular business. If it is giving you that much money, it is worth to invest, right? So I think that is what I had for you. If you have any questions, any specific questions for me, I think we have maybe five more minutes to spare.
Yes,
Just
participants, now you can ask the questions.
if you have any specific questions for me,
Yes,
I can take your questions now.
yes. You nicely point out the source of all the data also.
Yeah. And it's important. See, finally, even if you can use Excel, it comes down to where is it that you're going to use this practically. And
Yes.
you would be using this practically only for listed companies. Unlisted companies, I'm not sure how much that is relevant, right? So for listed companies, if you want to invest on a particular stock, you can directly take the data. This, again, the source of this depends how you perceive it. I perceive it to be something that's authentic. If you want to be even more authentic, go to the website of that company, download the standalone or consolidated financial statements, and from there you put that figures. And you just need 3 to 4 figures, right? We need interest, we need the total borrowing, we need the total tax amount, and the profit before tax. You can get these figures from the financial statements. For the market value of equity, you still need to rely on the current market price, which you can get directly from the BSE or NSE anywhere for that particular day. So that's from where you should consider and do the calculation, right?
Yes.
So if you have any
Participants, you
questions
can
for me,
raise your doubts.
I see Ranjita saying that she liked it. Vijay Lakshmi is saying kindly share the Excel sheet. All right, I'll do that. I have no issue sharing my Excel sheet with you.
Yes.
Share this Excel sheet. In fact,
Sir,
this,
there is one question. Is
Yeah.
there any possibility for integrating AI in cost of capital calculation?
Yeah. So for AI, the only thing that it can pick up is these figures can be picked up from one particular source if that source is fixed. For example, now I was doing this by going and manually searching for interest expense of one particular company. If you can integrate AI in this Excel sheet, it can directly pick that figure on a live real-time basis, and your calculations would be auto-updated. That's the only way, that's the only source or the only way that you can use AI. Otherwise, I don't see any relevance of AI for the capital. Only time that it changes on the basis of market value, maybe you can fetch the market value on a daily basis if you just connect it with the current market value from the stock exchange, right? So that's it. Otherwise, this is a straightforward calculation. You get the data, you get the weights, and you calculate.
Okay.
Okay.
Yes, participants, any questions?
Yes. All right.
All right. Okay.
If there are
Thank
questions, I think we
you.
are good to conclude.
Thank you, Nikhil sir. If
Thank you.
possible, you can share the Excel sheet
Sure.
to my WhatsApp. I will share in the group.
Sure. I'll do that.
Yes.
Let me check whether I can just share this right now to everyone.
Yes.
If I have that option to just attach the file here, I will attach the
Yes,
file
you
here.
can attach.
So I'll just attach the file here itself so that you can get this. All right. Okay. I think that's it from my side. Thank you, sir. Thank you for this
Yes, yes.
opportunity.
Wait, sir. We
It has
can.
been lovely.
Vaishnav, you can give formal vote of thanks.
Yes, sir.
Yes.
So as we come to end of this enriching session on financial analytics, I would like to take a moment to express my heartfelt gratitude. First and foremost, I extend my sincere gratitude to the Almighty for His blessings which made this event a success. I extend my deepest thanks to our esteemed speaker, Nikhil Kulkarni, for sharing his valuable insights and expertise with us. Your session has been incredibly informative and has provided us with a profound understanding of the practical aspects in cost of capital using Excel. I would also like to express my heartfelt gratitude to the management, Dr. Aloysius Edward, Dean, Faculty of Commerce and Management, Dr. Joseph Charles, Head, School of Management, and faculty member and participants for their active participation. Thank you.
Thank you, Vaishnav. Thank you, Nikhil sir.
Thank you.
Thank you.
I'm not able to share the file here, but I'll share that with you, sir. You can
Yes,
share.
you can share with me in
Yeah.
WhatsApp
Yeah.
or in mail, whatever it may.
I'll do that. I'm not able to
I will
attach it.
share
I'll
it.
share it to you. Okay.
Okay,
Thank you,
sir.
guys. Thank you. Thank you.
Thank you.